Welcome to our channel, Finance Experts. Now let's consider what is the psychology of investing and how to stay calm in a volatile market. Regardless of experience level, investing in the stock market can be a difficult undertaking. It might be challenging to maintain composure and concentration while dealing with volatile markets and equities that fluctuate continuously. But it's crucial to keep in mind that the secret to successful investing is understanding the psychology behind it. Investors can make rational decisions that may result in long-term gains by controlling their emotions and maintaining discipline. However, investing is frequently a crucial element in reaching our financial goals, whether they be accumulating wealth or establishing a sustainable retirement plan. Nevertheless, it can be difficult to maintain composure and focus on our long-term goals given the market's volatility. Understanding the psychology of investing and how emotions can affect our decision-making process is important for investors. What is the psychology of investing? Some books demonstrate how psychology can better explain human choices than financial theory, whereas traditional finance focuses on the methods employed to maximize return and avoid risk. Most investors find it unsettling to observe the ups and downs of the stock market. It could be tempting to sell your investments due to the worry of suffering significant losses. While doing so could temporarily ease your anxiety, the long-term financial impact could be severe. Here are some suggestions to keep you in control. Volatility. What is it? Volatility is a statistical measurement of a market's or a security's propensity to rapidly rise or fall in value. Usually, the standard deviation of the investment return over a specific time period is used to measure it. The square root of the variance of returns is the term used in statistics to describe the amount of variation or departure that might be anticipated. Volatile markets are typically characterized by significant and quick price changes as well as active trade. They may be the outcome of lopsided distribution of trade orders in one direction. Many investors become alarmed and start to doubt their long-term investment strategy during unpredictable periods. This is particularly true for new investors who may frequently feel tempted to leave the market altogether and wait until it feels secure to return. Should I sell stocks during volatile markets? The common response is no. Prices rise as market volatility decreases over time. By sticking with your long-term plan during difficult times, you may also be able to buy more shares of stock when they are on sale. However, it may be wise to switch out of stocks into more conservative investments when volatility occurs. If you are in a situation where you need the value of your assets fairly quickly or for income to live on. It's important to understand that market volatility cannot be avoided. The short-term ups and downs of the markets are in their nature. Timing the market is an extremely difficult job. Maintaining a long-term perspective while ignoring short-term changes is one solution. This is a sound strategy for many investors, but even long-term investors need to be aware of unpredictable markets and the precautions they can take to avoid them. Put your goals first. If you invest, it's likely that you have long-term financial objectives, including saving for retirement or your children's education. By concentrating on these, you can prevent current events from diverting your attention or causing you to deviate from your route. Try to keep in mind that the secret to long-term profits is time in the market, not timing the market. Obtain comfort from history. From wars to prolonged global recessions, the world has seen several major shocks. History has shown that markets often bounce from downturns and go on to produce remarkable long-term gains regardless of the difficulties the global economy has encountered. Leaving your money in the stock market increases the likelihood that it will grow and amass a sizable pot for your future. Continue to diversify. Limiting portfolio losses by distributing your funds among a variety of asset classes, such as equities, bonds, real estate, and cash. This is due to the fact that each asset class may behave differently in a variety of market circumstances. Some will see value declines, while others will see increases. Over time, this serves to smooth out returns. A diversified portfolio should aim to invest in the asset types that perform best annually. It is very impossible to anticipate which asset class will do better on any given day, month, year, cycle, etc., as history has shown. Keep in mind that investing outperforms holding cash. Cash savings accounts frequently fail to keep up with inflation, which causes savers to lose value in real terms and run the danger of falling short of their objectives. Your money has the best chance of increasing faster than inflation over the long term if you are willing to embrace the risk that comes with investing and have patience on your side. Stop looking at your portfolio so frequently. Consider checking in less frequently with your portfolio rather than doing so frequently throughout the day, which can have a severe negative impact on your state of mind as an investor. It could be best to check yourself on a weekly, monthly, or even quarterly basis. It's generally a good idea to limit how frequently you review your portfolio for financial and emotional stability. If you don't, you might feel compelled to react to a sudden drop and wind up crystallizing losses that you might have otherwise recovered over time. Even for specialists, trying to predict market moves is pretty much impossible. Maintaining a well-diversified portfolio and putting your attention on the long term is far preferable. Mute the financial news outlets. As someone who personally consumes more financial news is reasonable, I offer this one with caution. But I'd be negligent if I didn't advise anyone who's having problems staying calm in rough markets to avoid paying attention to the financial news media. Major financial news sites all too frequently print headlines that thrive on sensationalism and quick takes that frequently overlook crucial information that must be taken into account in order to make sane investment decisions. Additionally, the talking heads in the financial news media frequently run the risk of not only sowing unwarranted seeds of doubt, but also confirmation, given the numerous improvised ways in which we, as consumers, can quickly access news on specific issues these days. At the very least, use caution when using the majority of conventional financial news sources, and until you've done your own research, evaluate any news or comments with an unbiased viewpoint. Work with a consultant. Working with a financial advisor has several benefits, one of which is having someone to hold your hand when things become rough. The emotions that all investors experience during a volatile market can be managed with the help of a good advisor who can act as a reasonable source. Your advisor ought to revisit your investing goals and assist you in making decisions free of emotion, which can be challenging to accomplish while sitting at home and reading the financial headlines. Additionally, working with an advisor allows you to have a new set of eyes to examine your portfolio. An unbiased advisor can offer ideas about which equities you would want to acquire more of and which ones might have more serious issues than just a market sell-off. One reason we overreact to volatility is that we forget that financial markets are a natural aspect. Market downturns are common, and we should anticipate facing many of them over the course of our investing careers, even though we often believe markets will continue to rise with that expectation level. Even an insignificant setback can be overwhelming. People are not designed to make logical investment decisions, which explains why we're so lousy at it and let our feelings override our analytical methods. However, selling your investments due to market volatility and adverse media coverage is a long-term solution for a short-term problem, especially when we are fearful. Before fearful market developments happen, think about how you'll react. That way, you'll be prepared and less likely to react emotionally. Try to keep your head up to reduce anxiety, protect your wealth, and put yourself in a position to benefit from the following bad habits. Keep your eyes on your financial objectives and create a long-term strategy with one of our experienced advisors. Thanks for being to the end of the video. Don't forget to like, share, subscribe, and tell us what you think about this video below in the comment section. Thanks for watching, and we'll see you in the next video.